If you're holding bank stocks right now, you may not like what I'm about to say, because when I quietly start walking away from an industry that I've owned for decades, I know people are going to ask a very simple question. What does Warren Buffett see coming that the rest of us don't? The title you're looking at, Warren Buffett Warning Get Out of These Three Banks Before the Crisis, is dramatic. That's how headlines work. But before we go any further, I need to be very clear with you. I did not walk onto a stage, point at a TV camera and say, get out of these three banks today. I don't talk like that, and I don't give personal trading instructions over the internet. What you're hearing now is a commentary based on public information, the banks I've been selling, the risks I see in the system, and the way I think about crisis and capital. Other people turn that into a headline. The purpose here is not to scare you, not to attack any individual bank, and not to tell you exactly what to do with your money. The purpose is to walk you through the logic. You can decide for yourself what to do with it. When you buy a bank stock, you're not buying a shiny building with marble floors and branches on every corner. You're buying a box of promises. A bank is, at its core, a very simple machine that has been made incredibly complicated. It takes in deposits, which can leave at any time. It makes loans and buys securities, many of which will be outstanding for years or decades. The people who run it are trying to earn a spread between what they pay and what they receive, and do that well for a long time. And you build a franchise, do it poorly, or mix in too much leverage and too much optimism, and you build a time bomb. I've seen both. I watched the savings and loan crisis. I watched 2008. I watched what happened when Silicon Valley Bank, Signature Bank, and First Republic imploded. In every case, people said the same things beforehand. Our capital ratios are fine. Our risk models are sophisticated. Our regulators are comfortable. And in every case, confidence evaporated faster than the ink on those sentences. Banks do not die slowly. They die suddenly. They live a long time on trust, and then they go away in a weekend. That's why when I look at banks today, I'm less interested in the marketing and much more interested in the structure, the balance sheet, the behavior of management, and the incentives that drive decisions. I'm asking questions that don't show up in the glossy slide deck. How much of this loan book is really safe, and how much of it is a bet on a world that no longer exists? How much of this bond portfolio is quietly sitting on big unrealized losses because interest rates moved up so fast? How much risk sits in commercial real estate that depends on office buildings staying full in downtowns that are half empty after the pandemic? Those are not abstract questions. They are very real. When I talk about dumb things banks have done, I'm not being poetic. I mean basic errors. Borrowing short and lending long without a margin of safety. Chasing yield when rates were near zero. Assuming depositors would behave the way they did in 1990, even though we now live in a world where a rumor on a smartphone can move billions in an afternoon. A banking system can absorb a lot of small mistakes. It cannot absorb a large number of banks making the same mistake at the same time. One thing I've repeated and will repeat again is the difference between depositors and shareholders. If you keep money in a well-regulated American bank, the system, the FDIC, the Treasury, the Federal Reserve, has powerful reasons to protect depositors. We saw that when regulators stepped in to make sure people with payroll to meet didn't wake up on Monday and find their operating accounts frozen. That doesn't mean you should be reckless, but it does mean the public interest is heavily involved in keeping depositors whole. Shareholders are different. Shareholders are the ones who get paid to take risk. They're the owners, and ownership comes with a possibility that is very real and very simple. You can get wiped out. When something goes badly wrong at a bank, the government will usually step in to protect the system and the depositors. That doesn't mean it will rush in to protect your shares. If you own a bank stock, you are putting your capital into a leveraged, opaque, confidence-sensitive institution in a world where information moves faster than ever before. You may be paid for that risk, you may not, The question I have to answer for myself is, given what I see, is the reward still adequate? For a long time, the answer was yes. I owned a lot of banks. Berkshire Hathaway had large positions in institutions like Wells Fargo, J.P. Morgan, Goldman Sachs, Bank of America, Citigroup, and others at different points in time. Some of those worked very well, some did not. Over the last several years, you've watched me do something else. I have reduced or eliminated stakes in several large banks and financial institutions. I have allowed a very simple fact to show up in our public filings. I would rather hold enormous amounts of cash in short-term treasuries than hold many of these bank stocks at today's prices and under today's conditions. That's the warning people keep referring to. When you see Berkshire Hathaway selling down a position in Bank of America or exiting Citigroup or trimming Capital One, analysts will line up to tell you what that means. Some will say it's a tiny portfolio adjustment. Some will say it's a devastating vote of no confidence. The truth is more nuanced. I don't call you and tell you to sell. I don't call the CEO and hold a press conference. What I do is look at the world as it is, not as I wish it to be, and I reweigh the evidence. Interest rates moved from nearly zero to multi-decade highs in a very short time. Trillions of dollars of bonds and loans that were made at low yields are now sitting on losses when you mark them to market. Commercial real estate, especially offices in big cities, is under pressure from remote work, changing behavior, and sometimes poor capital allocation. In that environment, certain banks face much more pressure than others. Some banks kept things simple. Some banks loaded up on longer-term assets at precisely the wrong time. Some banks have loan books that are more exposed to fragile sectors than you might be comfortable with if you knew the details. I can't sit with every investor in the world and go through each page of each bank's filings. What I can do is decide what I want to own. And when I see a combination of leverage, complex exposures, aggressive assumptions, and management decisions that I don't love, I don't need to wait for a headline that says crisis to start moving my capital elsewhere. Now, what about these three banks? The reason people keep using that phrase is because there are some very visible decisions in our portfolio that caught attention. When Berkshire Hathaway reduces a very large stake in Bank of America or exits Citigroup or scales back a position in a bank like Capital One, it doesn't happen in the dark. The filings are public and the numbers are big enough that nobody can miss them. Those moves don't automatically mean that any of those institutions are destined to fail. It doesn't mean depositors should panic or that you should assume the worst. What it does mean is that, in my judgment, the balance between risk and reward no longer looked as attractive as other alternatives. When cash and treasury bills yield a decent return with almost no credit risk, the bar for a bank to deserve my capital goes up, not down. In a world of low interest rates, many investors became numb to risk. They looked at a few percentage points of yield and said, that's something, I'll take it. In a world of higher rates, you don't have to do that. You can sit with liquidity and wait. You can say no more often. You can walk away from businesses where the downside is hard to quantify and the upside is not as extraordinary as it once was. That's what I've been doing. So when you hear get out of these three banks before the crisis, I want you to translate that in your mind into something less theatrical and more accurate. There are specific identifiable weaknesses in parts of the banking system. There are specific institutions whose structure, exposures, and decisions make them more vulnerable if the environment gets worse instead of better. There are specific actions I have taken, selling, reducing, or avoiding positions that reflect my concern. But it is not a crystal ball. It is not a personal instruction to you. It is not a guarantee that a crisis will arrive on schedule or that these exact three names will be the ones at the center of the story. It is a warning about patterns. Let me tell you how I think about those patterns, because that is far more valuable than memorizing three ticker symbols. First, I start with the basic economics of banking. A bank is a highly leveraged institution that can survive only as long as people believe in it. That means transparency, prudence, and character matter more here than in almost any other business. If I can't look at the people running the institution and convince myself that they are conservative stewards of other people's money, I don't want to be a partner. Second, I look at the asset side. What kinds of loans are they making? How concentrated are they in any one geography, industry, or type of borrower? Are they heavily exposed to commercial real estate that depends on a return to a world of 2019 office occupancy, when anyone walking around a city center today can see that things are not the same? Are they holding large bond portfolios with long duration that are sitting on embedded losses because of the rise in interest rates? Third, I look at the liability side. Where do their deposits come from? Are they sticky retail deposits from customers with long relationships, or are they large uninsured corporate balances that can flee at the first hint of trouble? How did those deposits behave when we saw stress in 2023? Did the bank need support, special facilities, or unusual measures to stay comfortable? Fourth, I look at the incentives. How are executives paid? Are they rewarded for growth in assets and earnings in the short term, or are they rewarded for maintaining conservative capital and risk profiles over the long term? Do they talk like traders at a hedge fund or like trustees of a public utility? When I combine those elements, I start to see a pattern in certain banks that makes me uncomfortable. In some cases, that has led me to sell down positions. In others, it has led me to avoid ever starting a position in the first place, even when the stock price looks cheap to people who only glance at a price-to-book ratio. What you've seen in recent years is a gradual but unmistakable retreat from many parts of the banking sector in my own portfolio. At the same time, you've seen a very large buildup of cash and short-term treasuries. That's not an accident. That's not indecision. That is a deliberate choice based on the trade-off I see between risk and reward. I don't need to predict the exact day a crisis will start to know that it's wise to reduce exposure before the music stops. When people see a headline saying, "I'm warning you to get out of these 3 banks before the crisis," what they really want to know is simple. Which 3 and why? In the filings you've already seen, 3 names show up over and over whenever commentators talk about this story: Bank of America, Citigroup, and Capital One. I'm going to talk about them now, but I want you to pay attention to something more important than the tickers. I want you to see the pattern of risk behind them, because that pattern exists in more places than just 3 logos on a screen. With each of these institutions, I wasn't reacting to a rumor. I wasn't reacting to a single headline. I was reacting to the accumulation of facts in an environment that had changed very quickly. When interest rates move as fast as they did, and when parts of the economy, like commercial real estate and consumer credit, are under real pressure, banks that once looked comfortably positioned can suddenly find themselves standing on a much thinner layer of ice. Start with Bank of America. For a long time, this was one of my favorite holdings in the banking world. Berkshire Hathaway owned a very large stake, and I was comfortable with that. I knew the company well. I liked the deposit base. I admired elements of the management. If all I did was react to past performance and brand recognition, I could have left that position alone and called it a day. But the future doesn't care about how fond you are of the past. When rates were near zero, banks, including Bank of America, accumulated significant portfolios of longer-term securities. At the time, that didn't look crazy. Everyone had been living in a low-rate world for so long that it began to feel permanent. Then inflation picked up, the central bank responded, and suddenly those safe bonds sitting quietly on the balance sheet were worth a lot less in market terms than their carrying value. Those losses don't always show up immediately in earnings. They sit in the corner of the balance sheet, labeled in ways that don't alarm most people, but they are real. When rates rise, the market value of those long-duration assets falls. If a bank has to sell them, the loss becomes concrete. If it holds them, the loss remains latent, but the capital cushion is, in substance, thinner than it appears at first glance. The question I had to answer was not whether Bank of America was a bad institution overnight. It was whether I wanted such a large amount of capital exposed to this combination of balance sheet structure, interest rate risk, and regulatory uncertainty when I had the alternative of holding cash and treasury bills with no credit risk at all. When you can earn a reasonable return simply by lending to the government for short periods, while keeping enormous flexibility to act when opportunities appear, the hurdle for a leveraged institution goes up. That's why you saw selling. Not because I had some secret piece of information, not because I saw a headline that frightened me, but because the arithmetic of risk and reward changed. I still own shares. That alone tells you I haven't written Bank of America off as doomed, but I was no longer willing to have the same kind of exposure I once did. That is the first part of the warning. Now look at Citigroup. This is a very different story. Over the years, Citigroup has been through multiple cycles of restructuring, simplification, and rebranding. It has global operations, complex books, and a long history of dealing with the consequences of past decisions. There are talented people inside that institution working hard to make it safer and better. I don't doubt that. But from my point of view as an investor, simplicity is not a luxury in banking. It is a necessity. When a bank is sprawling with operations in dozens of countries, with multiple business lines and legacy portfolios that date back to very different eras, the chance that something hidden in the machinery will surprise you is not zero. It's often higher than you like to admit. If the world around that bank were calm, if interest rates were stable, if geopolitical tensions were low, if credit cycles were benign, the complexity might be manageable. When all of those things are more volatile, complexity turns from a neutral characteristic into a source of fragility. So while I could have stayed and told myself that Citigroup would eventually deliver the turnaround story investors have been promised for many years, I chose not to. I asked a blunt question: if I didn't own this stock today, would I buy it right now at this price, in this environment, with this structure and this level of complexity, when I have so many simpler alternatives? The honest answer was no. And when the honest answer is no, the logical action is to leave. That's what you saw in the filings when Berkshire Hathaway exited its position. Again, that's not a verdict on the future of Citigroup. It's a verdict on whether I want my capital exposed to that particular combination of risks when the world is already full of uncertainty. The third case that people talk about is Capital One. If the first two are about interest rate risk and complexity, this one is more about the consumer. Capital One has built a large credit card and consumer lending business. It's a very capable institution in many respects. It knows data, it knows marketing, it understands how to segment risk among different types of borrowers. In an environment where employment is strong, incomes are rising, and credit conditions are favorable, that can be a wonderful business. But leverage is not just a balance sheet concept, it's also a macro concept. When households are stretched, when the cost of living has risen faster than wages for many people, when savings buffers from past stimulus or good times are running down, consumer credit becomes more delicate. In a credit card or consumer loan portfolio, your customers are not all the same. Some will pay on time no matter what happens in the economy. Others are fine until they lose a job, face a medical bill, or see their rent go up. A slice is always on the edge. When rates are low and growth is stable, the edge group is small. When rates are high and the economy slows, the edge group grows. Looking at Capital One, I had to think not only about the company's skill in underwriting, but also about the environment in which that underwriting would be tested. Late cycle consumer credit can look deceptively healthy on the surface right before problems emerge. Delinquencies often rise with a lag. Charge-offs rise after that. Investors who wait for the headlines sometimes find that the stock has already fallen a long way by the time the news makes it obvious. When I reduce or trim a position in a name like Capital One, it's not because I suddenly believe the business is run by fools. It's because the payoff profile changes in a world where consumer stress, higher for longer rates, and job market uncertainty are meaningful possibilities. I'd rather step back while things still look reasonably good than wait around to see how the stress test plays out in real time with my capital on the line. The common thread among Bank of America, Citigroup, and Capital One is not that they are identical or that they share some fatal flaw that guarantees a blow-up. The common thread is that each one, in its own way, sits at the intersection of risks that have become more dangerous in a changed world, interest rate risk on securities and loans, complexity and global exposure, and consumer credit in a strained household sector. When you put those threads together, you begin to understand why a headline writer might decide to summarize the story as "get out of these three banks before the crisis." It sounds like I'm making a specific prediction about specific institutions. I'm not. What I am doing with my own capital is stepping to the side of a lane that suddenly looks crowded and slippery. You might ask, if I'm so worried, why not sell every bank and declare the sector uninvestable? The answer is that the world is rarely that simple. Not every bank is carrying the same amount of long-duration securities. Not every bank is loaded with commercial real estate loans in troubled downtowns. Not every bank is built around the same mix of consumer credit. Some have more conservative cultures. Some have more stable deposit bases. Some have chosen to forego yield in exchange for safety, even when that decision made their earnings look weaker in the short term. A crisis is often a test of character that has been built over decades. You see who cut corners when times were good and who refused to, even when the market mocked them for being too cautious. You see which institutions were treating their business as a long-term stewardship of other people's savings, and which ones were treating it more like a leveraged bet on the continuation of the last cycle. My decisions about Bank of America, Citigroup, and Capital One are, in that sense, part of a broader judgment about the risk culture in parts of the financial system. I don't need to be able to tell you that on some exact date next year, a crisis will start and it will begin at some particular street address. I only need to see that the combination of leverage, duration, risk, exposure, and human incentives in certain institutions makes them less attractive than the alternatives I have. If I can earn a decent return in 3-month bills with the full faith and credit of the government behind them, and if I can wake up every morning knowing exactly what I own and what it's worth, then every risky asset has to compete with that. A bank stock that once looked like an obvious place to put money may no longer clear that bar. There is another element to this that investors often overlook, and it has nothing to do with models or ratios. It has to do with sleep. When I own a business, I want to be comfortable owning it through thick and thin. I don't want to wake up in the middle of the night wondering whether some mismatch between assets and liabilities is about to be exposed by the next Fed decision or the next headline about empty office buildings. I don't want to rely on the hope that depositors will behave rationally when fear is in the air. I don't want to be in a position where I depend on regulators getting every move exactly right in real time. If a particular bank stock makes me run through that list in my head too often, that's a signal. It doesn't mean I panic. It doesn't mean I call a press conference. It means I quietly move my capital somewhere else and I let the filings tell the story. So when you hear that I've been warning about banks or that my selling is a sign that disaster is imminent, I'd ask you to look beyond the drama and see the underlying discipline. I am constantly weighing the world as it is, not as I wish it to be. I am asking whether the owners of certain institutions are being paid enough for the risks they're taking. I am asking whether I, as one of those owners, need to take those risks at all, or whether I can simply sit on the sidelines with cash and patience. That is really what before the crisis means in the way I operate. It doesn't mean predicting a precise date, like a weather forecast. It means recognizing that some combinations of risk and behavior are more likely to run into trouble when the unexpected happens. It means taking action when you can, rather than when you are forced to. It means accepting that sometimes the best decision in investing is not cleverness, but restraint. If you followed me this far, you probably realize that this isn't really a story about 3 banks. It's a story about how fragile confidence can be, how quickly conditions can change, and how important it is to decide in advance how you're going to behave when the crowd starts shouting. The headline says, "Get out of these 3 banks before the crisis." You've now seen what sits behind that headline. Changes in interest rates, vulnerabilities in commercial real estate, exposure to consumer credit, complex balance sheets, and the way I've quietly moved capital away from certain names like Bank of America, Citigroup, and Capital One, while building up cash at Berkshire Hathaway. The question now is not what I've done. The question is what you do with that information sitting where you are. I want to talk directly to you as a individual investor, a saver, maybe a retiree, or someone planning for the next 20 or 30 years. You are not running a $1 trillion conglomerate. You don't file 13 F reports. You don't have an army of analysts. But you do have something that matters just as much: the ability to choose what kind of risk you will and will not carry into the future. The first distinction you must make in your own mind is the same one I make: the difference between being a depositor and being a shareholder. When you put your salary, your emergency fund, or your household savings into a bank account, you are not trying to be clever. You are trying to be safe and liquid. You want to be able to pay the bills, handle an unexpected expense, or move money when you need to. For that purpose, the question is not which bank will deliver the highest stock return. It's where is my deposit appropriately protected, diversified, and within the framework designed to keep ordinary savers from being wiped out. That is one set of questions. When you buy the stock of a bank, you are doing something entirely different. You are choosing to become an owner of a leveraged financial institution in a world full of uncertainty. You are not just betting on net interest margins or the shape of the yield curve. You are betting on the judgment, ethics, and prudence of people you will probably never meet, working in buildings you will probably never visit, managing exposures you will never see in full detail. If you blur those 2 roles together, you're going to confuse yourself. You might keep your deposits at a bank for perfectly sensible reasons and never own the stock. You might own the stock of a bank whose branches you never use. There's nothing inconsistent about that. What matters is that you are honest about what kind of risk you are actually taking. The phrase "before the crisis" is tempting because it sounds like someone is offering you a timetable: sell here, buy there, dodge the bullet, then jump back in when the smoke clears. In all my years, I've never met anyone who can do that consistently, including me. Markets do not send you engraved invitations announcing the exact date of the next event. They simply reveal in their own time the consequences of decisions that have already been made. What I can do and what you can do is decide the principles we will follow before the storm arrives. One principle I live by is very simple: if I don't understand it, I don't own it. That sounds almost childish in a world where everyone wants to sound sophisticated. But in banking, it's one of the most powerful filters you have. If a bank structure, exposures, and business model are so complex that you find yourself nodding along without truly grasping how it earns money and how it could lose money, you are not required to own it. You don't get paid extra for voluntarily walking into fog. Another principle is about character. Numbers matter, but numbers are produced by people. When I look at any financial institution, I want to know what kind of culture lives inside it. Does management talk like stewards or like gamblers? Are they honest about mistakes, or do they hide them until they're forced to admit them? Do they treat regulations as guardrails or as obstacles to be bent and worked around? You can't measure character on a spreadsheet, but over time, it shows up in the decisions that either keep a bank out of trouble or lead it into the same ditch as everyone else. Now, you might be thinking, that's all very well for someone with decades of experience and a front row seat to nearly every crisis of the last 70 years. What about someone who doesn't want to spend their life reading footnotes and stress tests? Here's the good news: you don't have to. You can make perfectly rational choices about your financial life without ever trying to predict exactly which bank will stumble next. You can choose not to concentrate your entire portfolio in a handful of cyclical financial stocks. You can choose to hold businesses in sectors that sell products and services you understand from everyday life. You can choose to maintain a cash buffer that lets you sleep at night and makes you less vulnerable to being forced to sell at precisely the wrong moment. If you structure your finances so that you're not standing on a knife's edge, you don't need to know the title of the next crisis documentary in advance. People sometimes hear a warning about banks and conclude that the correct response is to panic, pull all deposits, sell everything, assume the worst. That is not what I'm advocating. Panic is not a strategy, it's a reaction. And in finance, panic decisions often turn a difficult situation into a disastrous one. What I am suggesting is that you practice prudence long before panic has a chance to appear. Prudence might mean keeping your deposit balances in line with the protections that exist for savers, rather than leaving oversized sums in a single account just because it's convenient. Prudence might mean recognizing that a high dividend yield from a bank stock is not a gift from the heavens, but a potential sign that the market is nervous about future earnings and risks. Prudence might mean reminding yourself that no matter how carefully you read, there will always be parts of a bank's true condition that you cannot see from the outside. That's why in my own portfolio, I've been willing to let go of bank holdings and sit in cash, even when cash feels boring. Boring can be wonderful when the alternative is exciting for the wrong reasons. There's another lesson in all of this that extends beyond banks. The same discipline that led me to reduce exposure to Bank of America, exit Citigroup, and trim Capital One is the discipline that governs how I think about any business in an uncertain world. I am constantly asking, what has to go right for this investment to work? And what happens if the world doesn't cooperate? How much of my outcome depends on a favorable environment? And how much depends on the underlying quality and resilience of the business itself? A wonderful company with a modest rate of growth that you truly understand, purchased at a reasonable price, can do more for your long-term financial well-being than a supposedly cheap stock in a complicated, fragile industry that you don't really grasp. You may not get a dramatic headline out of owning a simple, durable business for 20 years, but you may get something far more valuable, the ability to live your life without staring at your brokerage account every hour when headlines about crises start to roll in. The phrase "three banks before the crisis" will one day be replaced by some other phrase attached to some other sector. Maybe it will be technology, maybe it will be real estate, maybe it will be something nobody is talking about right now. The pattern is always the same. A long period of easy money or optimism encourages risk-taking. Weaknesses are built into the system while everyone is celebrating. Then conditions change, and what looks safe begins to wobble. If you rely on headlines to tell you when to move, you'll usually be late. If you build a margin of safety into your financial life ahead of time, you won't need perfect timing. I've often said that what really ruins people in markets is not what they don't know. It's what they think they know that just isn't so. In the years leading up to every crisis, there are stories that become so widely accepted that they feel like facts. Housing prices don't fall nationally. Banks are better capitalized than ever. This time is different. Reality doesn't care about slogans. It cares about cash flows, leverage, incentives, and human behavior under stress. So if you want to draw something practical from a dramatic title about me warning you to get out of three banks, let it be this: question the stories that make risk sound harmless. Ask yourself whether the comfort you feel owning something comes from true understanding or just from repetition and familiarity. And remember that the ability to say no is one of the most powerful tools you have as an investor. You don't have to chase every yield. You don't have to own every sector. You don't have to follow me or anyone else into or out of a stock. You do have to live with the consequences of your own decisions. When I move away from certain banks and towards cash, I'm not trying to tell you where to click in your trading app tomorrow morning. I'm sending a quieter message. The world has changed, and the risks embedded in some institutions are not being fully appreciated by the crowd. I would rather hold simple liquid assets and wait for truly outstanding opportunities than pretend that nothing has changed. If a crisis comes and proves that caution was warranted, the goal is not to feel clever. The goal is to have the capacity to act when others can't. If no crisis comes and the world muddles through, holding some extra cash and avoiding a few marginal risks is not the worst mistake anyone has ever made. You don't get graded in life on whether you bought the exact low tick or sold the exact high tick in a bank stock. You get graded in a practical sense on whether you can send your kids to school, sleep at night, handle a job loss, fund your retirement, and avoid the kind of financial mistake that set you back a decade. If you remember that the noise around these three banks will fade into the background, you'll see it for what it really is. One chapter in a long recurring story about leverage, trust, and human nature. If there's one thing I hope you take away from all of this, it's that you are not obligated to play the game on terms that make you uncomfortable. You don't have to be the hero who rides every wave. You can be the person who quietly builds a solid foundation, avoids obvious dangers, stays patient, and lets time do the heavy lifting. Headlines will come and go. There will be more warnings, more crises, more stories about institutions that turned out to be less solid than they looked. But if you build your financial life on understanding, prudence, and a healthy respect for risk, the drama will be something you observe, not something that destroys you. That, more than anything else, is what I mean when I talk about getting out before the crisis. Not a scramble for the exits after the fire has started, but a calm decision made in advance to never crowd yourself into a place where one bad headline can take away the future you've been working for your whole life. When you strip away the tickers, the headlines, and even my name, this whole story really comes down to a few simple lessons. First, risk is rarely obvious when everyone feels safe. Before every crisis, there is a period when people are convinced that this time is different. Banks feel solid, prices look stable, models say everything is under control, but balance sheets don't care about feelings. Leverage, duration risk, and bad incentives will always show up sooner or later. The fact that something has worked for a long time doesn't mean it will work forever. Second, you don't get paid extra for owning what you don't understand. A bank can have a famous name, impressive buildings, and a long history, but if you can't clearly explain how it makes money and how it could lose money, you are guessing, not investing. That's true for banks, for tech companies, for any business. Understanding is your real margin of safety. If a position keeps you up at night, that's usually your mind telling you the position's too big, the risk is too high, or the business is too complicated. Third, there is no shame in choosing safety when the world becomes uncertain. When I move toward cash and away from certain banks, it's not because I enjoy being fearful. It's because optionality has value. Holding simple liquid assets may look boring from the outside, but in a crisis, cash becomes opportunity. While others are forced to sell, you get to decide. That is a very different feeling than watching your future depend on whether one institution survives the week. Finally, your financial life is a marathon, not a sprint. You don't have to nail the bottom or the top. You don't have to chase every hot story. What you do need is a structure that lets you stay in the game no matter what the market throws at you. A little humility, a lot of patience, and a healthy respect for risk will take you farther than any inside tip ever will. If you walk away from this video with just one idea, let it be this: you are not obligated to play on the edge of the cliff just because everyone else is standing there. You can step back, think slowly, and build a future that doesn't depend on perfectly timing the next crisis. Now, before we wrap up, I'd like to hear from you. What do you see when you look at the banking system right now? Are you more cautious, more optimistic, or a bit of both? Have you ever held a stock that looked safe until the environment changed? Share your thoughts in the comments. I read what people are concerned about, and your perspective might help someone else think more clearly about their own decisions. If this breakdown helped you understand what's really behind a dramatic headline, not just the three banks, but the way risk builds up in the system, then take a second to like this video. It tells the algorithm that this kind of calm, thoughtful analysis is worth showing to more people, instead of just more noise. And if you want to keep following along as we dig into other parts of the economy, from banks to tech to real estate to whatever risk is quietly forming beneath the surface, then subscribe to the channel and turn on notifications. That way you don't have to chase the next video. It will simply be there when you're ready to think. Most importantly, share this with a friend or family member who might be worried about the next crisis but doesn't know where to start. Sometimes one clear explanation is worth more than 100 scary headlines. Thank you for spending your time here. Take care of your capital, take care of your peace of mind, and I'll see you in the next video.